Today we're talking about how to analyze a rental property and how to easily get to the numbers to see if a deal is profitable or not. Stay tuned. Welcome back to Whiteboard Finance. My name is Marko and I'm here to help you master your money and build your wealth. If you're new to this channel, please subscribe below because we talk about personal finance, the stock market, real estate investing, and entrepreneurship. As I mentioned in the intro, we're going to talk about the Foursquare Method on how to analyze a rental property so you can understand the numbers. I did not create the Foursquare Method, but I did copy it from a couple of people who I really respect and who are actually successful real estate investors. I'm proud to say that. I don't want to reinvent the wheel if they already know what they're doing. So this is the easiest way for a newbie or a beginner to really understand each of the four components that go into a real estate deal. So I'm going to jump right into the numbers and I don't want to waste anybody's time, so let's get to it. So as you can see here in our first square, we have what's called income. So income is pretty obvious. It means the money that the property generates. So most people think that income comes from rental income. Obviously, that's probably going to be one of your biggest sources of income, but we also have things like laundry. If you have a coin-operated machine or if you have laundry on site, that can be a source of revenue. You can rent out a garage monthly, whether it's for a car or for storage. You can rent that out and increase your revenue that way. And then miscellaneous. There's a multitude of ways that someone can monetize an income property, and those are just some of them. So let's take some hypothetical numbers here. I live in Northeast Ohio. You can get a duplex here for pretty cheap. I'm going to hypothetically say that I'm in a B-class suburb. So let's say that you can get a duplex for about $200,000. That'll bring in right about $1,000 per side or per door, as investors like to call it. So 1,000 times 2 equals $2,000 a month in rental income. Just for simplicity's sake, I'm going to assume that we don't have a laundry. The garage comes with the property. We're not charging any extra for that. And let's say miscellaneous income is zero as well. So with that being said, the total monthly income that this property is bringing in is $2,000 a month. So now with income, there's obviously the opposite of that, which are expenses. So what are some expenses that you can incur? So you can have tax. There's tax on the property. There's going to be insurance. There's going to be your utilities. So utilities include things like gas, water, sewer, electric, garbage, things like that. So you can be in an HOA. An HOA stands for Homeowners Association. These are typically monthly or yearly fees. Things for taking care of common areas. If you're in a condo, you can help pull in money in the condo association and the board can make decisions. But for the sake of this example, let's pretend that this house is just a regular house, not in an HOA. So some other expenses, you can have landscaping or snow removal. You can have a vacancy factor. So what a vacancy factor is typically people use 5%. I'll use that for this example, but vacancy factor, you have to assume that, a little bit of the year, there's not going to be a tenant in that house. So you're not going to be getting the full amount of rent that you would up here. You have repairs. Okay. Then we have Capex. So Capex stands for capital expenditures. These are typically expenses that you save for over the long term, like a roof replacement or a driveway replacement. You know that you're not going to replace a roof every month or every year, but you know that after 20, 30 years that will need to be replaced eventually. So think of this as kind of like a savings account for the property itself. Finally, we have PM, which stands for property management. This is typically 10% of whatever your gross rents are. And then you finally have the mortgage or debt service. So I'm going to go through and give realistic numbers for each one of these. Let's say that the taxes each month are going to be right around $150. Insurance is going to be right around $100. Utilities, the thing with utilities is that although there's many of them, you can actually put that on the tenant. So you can make the tenant responsible for that. So not only are they paying the rental income to actually live in the property, you can actually assign them, hey, you're going to put the utilities in your name and you're going to be responsible for that. And that typically is a pretty big motivator, because if the utilities are in their name, that affects their credit, if that makes sense. So let's just say in this lease agreement, we're putting the utilities on the tenant, so that's going to be 0. As I mentioned earlier, this house is not in a homeowners association, so that's 0. The landscaping and snow removal and the grass cutting and all that, you can actually put in the lease for the tenant to be responsible for that. And that's what we're going to do in this house. So that's going to be 0 as well. Vacancy factor, like I said, we're going to use a vacancy factor of roughly 5%. And 5% of $1,000 is going to be, excuse me, 5% of $2,000. Sorry about that. And then the repairs, let's just count for $100 a month. That's just miscellaneous stuff. You know, if someone puts a hole in the drywall or something needs done with the bathroom, let's just all account on average for $100 for repairs per month. Now, Capex, this is going to be $100 as well. This is not a number that's set in stone, but again, over the course of X amount of years, there may be some big things that go wrong with the property, so you want to just be able to set this aside. So property management, like I said, property managers typically charge 10% of the gross rents. So 10% of $2,000 is $200. And the mortgage, or the debt service, like investors like to call it, what I did was I took the property that's hypothetically $200,000. We're going to put down a 20% down payment. So what's 20% of $200,000? That's going to be 40 grand. So the mortgage we're taking out is $200,000 minus 40 grand. We're putting down 40 and taking out a mortgage of $160,000. So if I did a 30-year mortgage at 5% on $160,000, it comes out to be right around $860 per month. So I went a little bit high on that interest rate of 5%. Right now, we're probably in the neighborhood of 4.4 at the time of this recording. But just to future-proof this video, because we know interest rates are going up, I just did 5%. So if we add up all of these expenses, we're going to come to a total monthly number of $1,610. That's a good estimate based on all these numbers that we're incorporating. A lot of these are factual because they're in the lease. Some of these are estimates like Capex and repairs. And also we know that property management and mortgage, that's a number that's set in stone. So 1610 is a good estimate for expenses. So let's go to the next quadrant of our Foursquare method. The third square we have is called cash flow. This is to see how much money the property is either making or losing per month. So this is very simple. All you do is you take your income, which we know is $2,000 per month, which we got from the income square, minus your expenses. So we know that the expenses are $1,610. So this leaves us with a very simple number of a positive cash flow of $390 per month. That's a very simple way to come up with that number. So how do you know if $390 a month is even a good investment, or if it's even worth your time to invest in these kinds of houses or these kinds of investments? That brings us to our fourth square, called the cash on cash return on investment. So the way to figure this out is cash on cash essentially means it's the money that you made on the money that you invested. So it's cash on cash return. So let's figure out how much money we have in this deal to see if this $390 a month in cash flow is even worth it. So let's start down with the down payment. Okay, we know that we put down $40,000 for the mortgage. Okay. The second factor are closing costs. So we never talked about how much it actually costs to acquire this property. So closing costs, these are things like title work, dealing with any commissions on a real estate agent, Since we're the buyer, we're not really going to be dealing with a commission, so to speak, that the seller actually pays most of those. But this could be, title work, paperwork, lending fees, mortgage origination, things like that. So let's just assume for this example that these closing costs were $3,000. The next line item is the rehab budget. So say this property wasn't perfect or wasn't tenant ready. I'm not saying that these properties have to be perfect for these people to live in, but they should be suitable and they should be safe, nice properties for a family or a person to live in. So with all that being said, let's take a rehab budget, and this property, let's say each side, each door needed $3,500. That's a total of $7,000 in rehab. Maybe we did some floors, maybe we did something to the bathrooms or the kitchens, whatever. We have $7,000 in rehab fees. So miscellaneous, this all depends on what else you want to do to the property or if you incurred any other expenses. For this example, just to keep it simple, we'll say that these are $0. So the total in terms of money down that we have here is $50,000, okay? And since I'm running out of room to write, just remember that. All of these expenses combined, 40 plus 3 plus 7, that's 50 grand. Now what you do is, in order to find out the fourth square or the cash on cash return, you take your $390 a month, okay? And I hope you guys can still see this. $390 per month. So you want to find out what you make in an entire year, okay? So this is an annualized cash on cash return. $390 times 12 is $4,680 per year. Now, some of the people that are pretty good at math already know what the next steps are. So what you do is you take this money that you make in 1 year, so this $4,680, and what you do is you divide it by the money that it took to get this return, okay? So this $4,680 divided by the $50K that we used up here, all the money in the deal, actually gets us a return of $9.36%. So how do we know if 9.36% is even a good deal or a good cash on cash return? Well, I would compare it to other available investments at the time. So take a look at your savings account. Right now, in a money market, you're probably going to be making 1.5%, if that. So this is an investment that's about 8 times better than that, okay? If you're looking at the stock market has historically returned right around 10%. Some years it's been a lot more, some years it's been a lot less. So this is maybe comparable to the average of the stock market. If you want to get into something a little bit more riskier, obviously you need to be compensated for that risk. So high risk, high reward. This right here, if you do the numbers and you keep good property management and good tenants and don't have a lot of turnover, this is a pretty good number for a relatively low risk investment, and you are being compensated for that risk with 9.36% of return. Now, let's talk about the last factor that the Foursquare doesn't address. We know that we bought this duplex for $200,000, right? We never know, or we never talked about how much we're going to sell it for. So what if in 5 years this duplex is worth $300,000? Now we're getting into a different metric called IRR. That's internal rate of return. You have all the money you made in terms of the cash flows, which we have $390 a month, and those are going to go up as well, because as a landlord we want to raise those rents every year by 2, 3, 4%. And you have the difference in equity of what you bought it for, which was $200,000, and what you sold it for, which was $300,000. So after all the realtor fees and all that good stuff, you're taking in the cash flows and also the appreciation of the equity. And that number is obviously going to be higher than 9.36 over time. But that number could also be lower if you're selling it, or you have to sell that duplex at a number less than $200,000. Does that make sense? So I hope everyone got good value out of this video. This was my first real estate investing video, but I do own 3 units myself. I have a duplex and also a single family. And I use this for my numbers. Obviously, I use something a little bit more sophisticated like a spreadsheet, but this is a good way for new investors to really dig into the numbers and see if an investment would be profitable or not. So if you got any value out of this video, please share this with one friend, like and subscribe if you haven't already, and most importantly, have a prosperous day. And another expense that you may have is if your tenant is a piece of trash and he hasn't paid rent in 3 months and he's milking the eviction process because you're in a landlord-unfriendly state and it's costing you not only income from the property, but court fees, lawyer fees, legal fees. Don't you just love real estate investing?